For the past several years, buying a car in the United States has been difficult. Prices surged rapidly. Inventory disappeared from dealer lots. Markups became common. Interest rates climbed to multi-year highs. Many buyers delayed purchases, hoping conditions would improve. Now, as we move through 2026 and into 2027, the market feels different. Inventory has returned. Discounts are appearing again, but monthly payments remain high. So the real question is simple. Are car prices finally dropping in the US? Or are we only seeing small adjustments in a market that is still historically expensive? In this video, we break down what's actually happening. New vehicle pricing, used market corrections, supply levels, loan rates, and what it means if you plan to buy in 2027. Let's take a closer look. The big picture, where the market stands. In 2026 to 2027, the U.S. auto market experienced extreme volatility earlier in the decade. Supply chain disruptions, semiconductor shortages, labor gaps, and global shipping delays restricted production. At the same time, consumer demand remained strong. Between 2020 and 2023, vehicle prices rose sharply. Many models sold above MSRP. Used cars appreciated instead of depreciating. Negotiation nearly disappeared. Buyers often paid premiums just to secure inventory. By 2026, the landscape has changed. Production output has stabilized. Supply chains are more reliable. Dealership inventory has improved across most segments. Automakers have adjusted pricing strategies. However, stabilization does not mean prices have returned to pre-pandemic levels. What we are seeing in 2026 to 2027 is normalization, not reversal. That distinction matters. New car prices. Are they actually falling? New vehicle pricing in 2026 to 2027 is no longer accelerating the way it did during peak shortages. The rapid inflation phase has ended. In many segments, price increases have slowed significantly. Incentive programs have gradually returned. Dealer markups are far less common. Negotiation leverage has improved, but average transaction prices remain elevated compared to historical standards. Why? Because automakers changed their strategy. Instead of prioritizing base models with low profit margins, manufacturers shifted production toward higher trims, premium variants, SUVs, and trucks. These models generate stronger profits and protect revenue stability. As a result, even though extreme price spikes have cooled, the overall pricing baseline is higher than it was before 2020. Discounts exist, but they are selective. Popular trucks and high-demand SUVs still command strong pricing. Slower-moving sedans and certain electric models see deeper incentives. So in 2027, buyers have more flexibility, but they are not returning to pre-crisis pricing. Used car market. A clearer correction. The used car market shows a more noticeable shift. During the inventory crisis, used car prices surged aggressively. In some cases, lightly used vehicles were priced close to, or even above, new ones. Depreciation patterns temporarily disappeared. By 2026 to 2027, the used market has cooled. Wholesale auction values have stabilized. Depreciation curves are returning to traditional patterns. Vehicles are losing value again at predictable rates. However, the correction is uneven. High-demand models, especially reliable compact SUVs, full-size trucks, and fuel-efficient hybrids, continue to hold strong resale value. Meanwhile, certain luxury sedans, older high-mileage vehicles, and previously overvalued models have seen sharper price adjustments. The used market is softer than the new market, but it is not collapsing. It is correcting toward long-term averages. Inventory and supply. The core driver. Inventory is one of the most important factors influencing prices in 2026 to 2027. During the shortage years, dealerships operated with minimal supply. Buyers had little choice and almost no negotiating power. Today, inventory levels are healthier. Production pipelines are more consistent. Semiconductor availability has improved. Shipping networks are more efficient. Fuller lots mean slightly increased competition among dealers, but automakers have adapted. Many brands now intentionally manage production volumes to avoid oversupply. Maintaining balanced inventory protects pricing power. Manufacturers learned that leaner inventory reduces heavy discounting, so while supply is stronger, it is not excessive. The result is a balanced market, not a buyer's market. Interest rates. The affordability factor. Even if vehicle prices soften slightly, financing remains a major challenge. Auto loan rates in 2026 to 2027 remain elevated compared to the ultra-low rates of the late 2000s. Higher interest rates significantly increase monthly payments. For example, a modest $1,500 discount on a vehicle may be offset by thousands of dollars in additional interest over a multi-year loan. This means affordability depends not only on vehicle pricing, but also on borrowing conditions. Buyers with strong credit scores have more leverage. Those financing longer terms may still face high overall ownership costs. Price stabilization does not automatically equal affordability. Financing conditions matter just as much. Segment differences, where prices are softer. Not every vehicle category behaves the same in 2026 to 2027. Segments showing clearer softening include certain electric vehicles facing increased competition, select luxury sedans, models that previously carried heavy dealer markups. Segments that remain strong include full-size trucks, popular mid-size SUVs, reliable compact crossovers, hybrid vehicles. Hybrids continue to attract steady demand due to fuel savings without charging concerns. Understanding which segments are cooling and which remain firm is critical for smart buyers. Is 2027 finally a good time to buy? Car prices in the United States during 2026 to 2027 are not crashing. They are stabilizing. The extreme inflation period is over. Dealer markups have largely faded. Incentives are returning gradually. Used vehicles are correcting toward historical depreciation trends. But average pricing remains elevated compared to the pre-pandemic era. What has improved is predictability. Buyers now have more options, more inventory, slightly better negotiation leverage. However, high financing costs still limit affordability. In 2027, timing matters less than preparation. Research your segment carefully. Compare trims, monitor incentives, watch interest rates, and negotiate strategically. Are car prices finally dropping in the U.S. in 2026 to 2027? The honest answer? They are stabilizing, not collapsing. The chaotic inflation phase has ended. The market is calmer. But dramatic price reductions are unlikely unless economic conditions change significantly. For informed buyers, 2027 offers something valuable: stability, more inventory, fewer panic markups, more rational pricing structures. Before purchasing, evaluate your financing options, analyze segment trends, and approach the dealership prepared. The market is more balanced, but smart decisions still matter. So, are car prices finally dropping in the U.S. in 2026 to 2027? Not dramatically. But the market is no longer chaotic. Inventory is healthier. Markups are fading. Used prices are correcting. Buyers have more leverage than they did a few years ago. However, high financing costs still play a major role in affordability. The opportunity isn't about waiting for a crash. It's about making a smart, well-timed decision. If you're planning to buy in 2027, focus on the segment, monitor incentives, compare financing options, and negotiate confidently. The market has stabilized. Now it's about strategy. If you found this breakdown helpful, consider subscribing for more U.S. auto market updates and smart buying insights. See you in the next video.